We are all exposed to a ton of investment information all the time. So how do you really sort through it all and set yourself up so we can get good long-term rates of return on our investments? So what we're going to talk about today is your top 17 investment strategies. Do they actually work? So that we're going to go through. We're going to talk about are stocks random, and it's a more important question for basic understanding than you think. So we're going to talk about why it's important. Are stock markets efficient? And then we're going to go kind of through the history of market thought through academics and how that's all gone. And then we're going to look at the top 17 investment strategies and see what actually works. And then we're going to talk about how to identify all-star fund managers, like how to find these world's best investors to invest for us. Okay, so that's our topic today. It's quite comprehensive talk about investments and how do we make sure we get the right returns long term. So let's go back to the 1950s. There's a thing called the capital asset pricing model. Okay, invented by Harry Markowitz. So it calculates the expected return of an investment. This is the beginning of the educational thinking of early educational thinking about money. So basically, it focuses on what's called beta, which is the systematic market risk. And the way the formula is a bit more complicated, but basically it's the rate of return you expect is the risk-free rate plus beta. And it kind of said that all stocks should conform with the market return, and beta was measured as 1. So for example, a 1.5 would be a stock that went up 1.5 times as much as the market, and then went down 1.5 times as much when it went down. So that was how it was thought. And then, so the only way to get a higher rate of return was to buy a riskier investment with a higher beta. So it was the capital asset pricing model. Now, what that led to is the next level, which is the efficient market theory, often called EMH, and it's the two of them are often thought to be quite related. There's a book called The Random Walk Down Wall Street by Burton Malkiel, which talked about this quite a bit. So basically, the idea is that the market is efficient. Okay, so it's basically all the current investment expectations of all investors is what makes up the current market prices. And the thinking is investors are rational and they're bidding for companies, so that's really the fair price for what they're worth. So that means when the prices move in the future, it has to be based on new information comes out. We don't know what information is going to come in the future, so therefore stock returns are random. Okay, that's the thinking here. So market movements are random, and if they are, then nothing can beat the index because you can't predict the future. Okay, so the thinking is that all stocks are priced at their actual value at all times, which is what investors are willing to pay for those stocks. So investors are rational and see all publicly available information, so they know what's out there. And there's actually 3 levels of this efficient market theory, because originally, so not nearly everybody, like a lot of people were disagreed with it. So it came up with 3 versions. So one is called the weak EMH, which is basically the historical market prices and the financial data. Historical information is known, but nothing new. So this way would basically mean that technical analysis or chartists wouldn't work, but fundamental analysis wouldn't work. Would still work, right? So then there's a semi-strong EMH, which is all public information is known. So in this way, so fundamental analysis of analyzing companies would still work. Okay, then the strong EMH is basically all public and insider information is built into the price of stocks. So therefore, even insiders couldn't beat the market. That's the thinking. And then, so a lot of people debated about to what extent is the market efficient and all that. So these two, the capital asset pricing model and the efficient market theory, they kind of dominated investment thinking through the 1960s up to the 1980s. So, and that was kind of the foundation for index investment. Now, index investing, people are thinking, well, you know what, we can't predict what's going to happen, so the market's efficient, so let's just buy the whole index. Now, the truth is, you're not actually buying the index, you're not buying all companies with an index. So an index is really a fund. Think of it like a mutual fund or an ETF, but bought with a specific method. So they have a certain number of companies, and they don't change them too often. They announce ahead of time what they are. It's mostly based on the largest and most liquid companies. So Now, so the US is about 6,000 stocks, and the S&P 500, the main index, is only 500. Globally, there's about 45,000 stocks. The MSCI World Index is about 1,500. So it's nowhere close to all the companies. But in both cases, it is the bulk of the money that's in the stock market. So that's in index investment is kind of a low-cost, steady way to getting a broad exposure to the market. So now, based on efficient market theory, future stock market movements are random, so nobody can predict them. So index investing should work. Now, in truth is, most active managers actually lag the market, lag the index. So when we're talking about the market, we're talking about the index. So, and part of that is that the index doesn't have there's hardly any fees. There's very much lower fees in it. So most fund managers don't actually add enough value from their stock picking to cover their fees. So now there is a SPIVA report that comes out every year, which is a bit of a pet peeve of mine, because SPIVA is put out by Standard & Poor's, who also puts out the index. So it's kind of their own marketing document saying, nobody can beat our investment. So, and what they do is they said it's an impossible target. So they said, they say the active managers don't consistently beat the index. Now that's something you'll learn about here, the word consistently. So now I might come back to that as always. There's no equity index or no equity investment that consistently beats my checking account. So consistently usually means every year. And if you're investing in the stock market, doing something every year is not a relevant goal. What's relevant is I'm going to invest for 20 or 30 years and I want to outperform over time. So if I have an investment that beats the market over 20 years, whether it does it all 20 of those years doesn't matter to me, as long as it beats it over the long run. So that's the problem with some of these reports, is they say the fund managers don't beat the index consistently, but that's not actually an important information. The question is, are they going to beat it over time? Now, still, it's true that most of them don't, but a certain number of them do over time. So now, so when funds actually lag, the thinking, what you see in the media always is it's all based on fees, or maybe they're lacking skill. But from seeing all kinds of fund managers working, what I found is the vast majority of them are seriously not really trying to beat the index. So what they're doing is trying to have a reasonable return with less risk. Okay, so my view is, this is a very just anecdotal, but my guess is only about 20% of funds out there are seriously trying to beat the index. Most are just trying to be somewhere close to the index and be less volatile, and because they don't want to lose clients when they're down. So that's actually a major factor of it. It's part of the marketing program of how these they project themselves, they present themselves. So that's a big part of what it is. So part of it, we're trying to find the ones that perform. You got to start with the ones that are seriously looking. Now, so that was the index investing, and all that was kind of the 60s to 80s thinking, and a lot of the index investing is still a major part of what the thinking now is. But the other side to it is what's called value investing. It's actually has been around since, I guess, significantly since the 1930s, and it's moved up, and it's still a significant part of investing now, and it's quite different from the index investing idea. So here the idea is to buy undervalued companies. Okay, and so basically you're buying $1 for 50 cents, and if you're buying them undervalued, you should get a higher rate of return over time. So the thinking often is you really make your rate of return when you buy, not necessarily when you sell, because you buy low enough. So in value investing, they calculate an intrinsic value, quote unquote, for each stock. So basically they estimate the profits that the company is expected to make over time, and they bring it back to today's dollar and calculate an intrinsic value and say that's what it's actually worth. Now, so in contrast to the efficient market theory says every stock is priced correctly at every time, value investors say the vast majority of stocks are priced wrong the vast majority of the time, because they figured out what they think they should be worth, and that's not what they're trading for. So we're saying that stock markets are wrong. Markets are not efficient. They're not random. They're not rational. And the emerging markets, or the EMH efficient market theory, is wrong. with value investing. So this started back with Benjamin Graham and David Dodd. They wrote a book back in 1934 called Security Analysis. Came out in the middle of the Great Depression, and then a subsequent book called The Intelligent Investor. And these are two of the big investment classics out there. So there was a bunch of followers. The most popular one is Warren Buffett, who followed this value investing strategy. So now value investing has generally outperformed the index over most of history. It's been quite an effective way to invest. So now it has lagged since 2006, and it's led to a lot of articles recently. Is it dead? Like, what's ever happened? So there's been it's outperformed for like 70 or 80 years, and all of a sudden now it's not working the last, and that's 15 years. So has something fundamentally changed? And a lot of it is that the value investors don't have the big technology companies. So it used to be, so most companies produce something. Now what happens is a lot of technology companies will produce something where the cost is almost zero. It's a digital asset that they're selling. So once it's designed, it doesn't really cost anything to make another one of them. Like you produce a song, and once it's out there, you can send it to people. It doesn't cost anything more to send it out. So it changes the way calculations are done, and it's brought to some huge gains by specific companies. For example, Elon Musk's Tesla and Jeff Bezos' Amazon. And so a few of these big companies in the last 15 years have mushroomed largely, and value investors wouldn't have those. So that may be a factor. So, but it's a big debate in the investment industry about, is value investing dead? Is it still work? It's been working for so long. It's such a solid method, but it hasn't worked for 15 years. So what's going on with it? So now, value investing generally works better with small caps and international or emerging markets investing. So that's one type of investment. We're going to go through a bunch of them here and see what they do. Another interesting thing, this is, I guess, part of the history of thought was behavioral investing. So again, when people thought that, all investors are rational, that was the efficient market theory. So, but then came out with these, the guy Richard Taylor, Daniel Kahneman, and Amos Tversky. So their argument was investors aren't rational. It's actually mostly based on emotion. It's mostly fear and greed, or as Charlie Munger would say, it's really fear and envy that drives people. So, people tend to buy more and more as the market goes up and sell more and more as it goes down. And a lot of it's behavioral, not rational at all. So there's a whole bunch of books out of the kind of the classics, sort of the best known ones are Thinking Fast and Slow by Daniel Kahneman and Predictably Irrational by Dan Ariely. So basically most investors are irrational. And this actually includes professional investors. It's amazing how many of them, even though the pros tend to get caught up in all of this. So, a classic here was, back in 96, Alan Greenspan, the head of the Fed, with his quote about irrational exuberance. It's kind of what happens a lot with the market. And you see that when you see studies of when people buy and sell stocks, quite predictably, people tend to sell at the bottom and buy at the top. The month when more stocks were sold than any other month in history was in February 2009, right at the bottom of the market. That's when you should be buying. It's the biggest sale of stocks. I had an article on that month going out on my blog saying, this is the best buying opportunity of your life to buy. And yet that was the month that most people were selling. So it's predictably irrational investors. So Warren Buffett always talks about this thing called Mr. Market, and this is kind of how he sees the investments. So he's buying companies that are making money over time, and he buys them at a good price. He's going to hold them over time, and he says the market is kind of like, just think of it, some moody, irrational guy who all the time keeps saying, "Oh, do you want to buy this company for this? Do you want to buy it for this price?" And it's constantly quoting prices for it, and they're often irrational, ridiculously high or low or irrational. And so the market itself, he sees it as this moody, irrational kind of thing has a price for stocks. But you have to know the reason he thinks he does well is because he's picked companies, he knows what they're actually worth, and he'll only buy them when they're low and only sell them when they're high. So behavioral investing, again, the fact that humans are humans is a big another evidence that the efficient market theory doesn't apply, isn't actually true for real humans. So now finally, it actually got settled with Professor Jeremy Siegel with his book Stocks for the Long Run. So let me just show the book. This is I've read almost every book that he's written. This is the latest version 6 is just out. I think it's the best stock market book out there. But he actually proves in his books that the efficient market theory is false. And the random walk, the book is the random walk down Wall Street are that stocks are random, this is false, and he proves it. So, and he's got a study which I'll show you in just a minute. So what he actually found is actual stock market returns are more consistent than you would expect based if they were random. So, and the risk over time falls faster than you would expect. So the longer you hold stocks, the lower your risk comes, and you would expect a certain amount of that if it's random, but it actually falls much lower. It's called mean reversion. Okay, so now so a random walks would suggest that you could have many bad periods in a row. So if we have, the Great Depression and 4 huge bad years, well, you could easily have more because it's random. They're not correlated to the past. If it was random, you could have another 4 and then another 4. You could have all kinds of bad periods in a row. Truth is that doesn't ever happen. And I'll show you this in a minute too. But when you look at stock market history, what you see is the largest gains are right beside the largest losses. So the biggest day, week, month, or year, the biggest days ever are often the day after or the day before the biggest decline. And so it's there, and there's a very definite correlation between big gains and big losses. They tend to offset, often right away, but more reliably over time. Now, a lot of advisors may show you, the charts that say if you miss the 20 best days in the market, this is kind of the argument for being invested all the time. If you miss the 20 best days, then look how much of your return you lose. This doesn't really make sense because if you miss the 20 best days, you'll probably also miss the 20 worst days because they're mostly right beside the 20 best days. It'd be really hard to miss the best days and not the worst days that are right beside them. So, no. Now, bond market, on the other hand, is the opposite. So the market returns, the bond market returns, the risk declines less than you'd expect based on random. And so, so it's actually called mean aversion. So it's not reversion, it's aversion. It's the opposite. So what we see with bonds is when they have bad periods, they tend to be very long periods. Like we had a kind of a 40-year period from 1940 to 80 where bonds did quite badly, and then from the 80s till up till 2021, or 2020, just when the start of the pandemic, we had what's with a bond bubble where they did really well for 40 years. You get decades where they do well and decades where they do horribly. So, and this bond bubble, it's because interest rates were going up and we had high inflation. So we had bad returns. Now, the last 40 years, we had low inflation, interest rates coming down pretty well every year. Now they've bottomed and they're up again. So the return of the last 40 years for bonds is like, we're never going to see that again. We're in a different variation again. So bonds are that way. They tend to when things go bad, they keep going more and more bad. So now here's the actual study that Jeremy Siegel did. So it shows stocks, bonds, and cash as an investment, and how they've done. So this is over the time period, and the actual numbers is what's actually happened to them. And the dotted lines here are what you would calculate if they were purely random. And you'll see the longer the time period, the farther out it is. So when you get to 30 years, like stocks are actually barely over half as risky as you would expect them to be randomly. And yet bonds and cash, they're significantly more risky than you'd expect them to be randomly. So bottom line is, this random walk hypothesis is just false. It's just way out. Now, it's reasonable in short periods of time, but over the long term, it just doesn't hold any water whatsoever. So amazing study by Jeremy Siegel. So just to show you that a little bit more, this is again, stocks, bonds, and cash. This is standard deviation, a measure of risk or how uncertain the returns are. And you'll see everybody says stocks are riskier than bonds and cash. This is a picture of risk, right? And which is definitely true over short periods of time. But when you get to 20 years or 30 years, longer periods of time, you notice stocks are actually more predictable than bonds, because the risk for them goes down and down over time, while the risk for bonds it goes down at a much slower period. So now this is the S&P 500. I'm going to show you this to show you that the best periods are beside the worst. So, this is, you see, these are individual, each line is the gain for that calendar year, last 150 years. So let's take the losses over 20% and see what happened right after them. So this was here back 1907, I think it was a loss of over 20%. The very next year, gain of 40. Okay, so, and that is really what I'm showing you is basically, with the odd exception, any loss of 20% or more, the very next year is almost always a gain of 20% or more. So here, this is a Great Depression. There were 4 down years in a row, including a -20 and a -40. And you had to wait a year, but then there were 2 gains of almost 60%. It's actually the biggest bull market in history. It was in the middle of the Great Depression. This is the biggest decline in history. And this is the biggest gain in history, these 4 years and these 4 years. So 1937 was a loss of over 30%, but the next year, okay, we didn't quite make 20, but it was a good year. So then here in 1974, had a loss of about over 20%. Very next year, almost 40. 2002, a loss of 20%. Very next year, a gain of 30. 2008, a loss of close to 40. The very next year, a gain of close to 30. So you see that it's the big gains almost always follow them. So it's not random at all. They tend to really follow each other. Well, now, that's kind of the history of thought and some of the main investment methods and something about that. So once we start realizing, okay, you know what, the markets aren't random. So then the thought is, well, what works then? Well, let's think about what actually does work. How do we actually understand them? And it came into all this different kinds of, it's called factor investment. A factor is just kind of a method of figuring it out, trying a systematic method of trying to figure out what might work. And there's all kinds of them. And we're going to look here at the top 11 and just talk a bit about them and what they are and see if they work. And so the concept here basically is, if any of these work, it always disproves the efficient market theory. Now, Jeremy Siegel's already disproved it, but you can't say the markets is, for example, is efficient and then something systematically other than that beats it. You know what I mean? So let's take a look at what these methods are. So one of them is small cap investing. So just buying smaller companies. Now, in general, if you go back over the last 95 years, small companies have outperformed the large company, the overall market. Okay, so generally this tends to work. The problem with it is it tends to be only they tend to outperform by quite a bit in one decade and then lag for several decades. So, and so over the 95 years, they've outperformed by 2% per year for 95 years. That's actually a lot when you do the math of it. So, however, they outperformed by 20% per year for 1 year, 9-year period for the mid-70s to mid-80s. But outside of that decade, small caps have actually underperformed all the rest of the time. So for 85 years, they've underperformed. But that period, when you add that in, that's done it. So small caps do outperform, but it's just occasionally, not nearly that consistent. So that's why it's often good to have some of them in your portfolio, but not the big part about it. So now another thing that's strange is they've outperformed widely in January. So the returns actually was shown that it's called the January effect. I'll talk more about it later on. But small cap stocks for many years very consistently made money. Even in the Great Depression, when we had these huge losses every year, the small cap still had big gains in January. It was just constantly a thing. Now, thing about it is now it got talked about so much that everybody knows in December, oh, small caps are going to go down next year, and it stopped working. So this whole, assume small caps are going to make a lot of money in January, stopped working 20 years ago. So now, again, small caps work best with value investing. And so, if you look at the best groups, small cap value and large cap growth tend to be the two top performing methods, as opposed to, mid cap or as opposed to large cap value and small cap growth. So, okay. So the next one is momentum investing. So this basically is the idea is that if a stock is rising, they tend to keep rising for a while. And the studies show they tend to rise for, 1 to 3 years. They tend to rise for a little while. So again, it's not random. Once they're starting a trend, they follow for a while, and then then it reverses. So this is called trend following. And you may hear lots of people talk about make the trend your friend. And that's what it's based on. And, there's all kinds of computer trading models. And the truth is that the vast majority of them, this is basically all they do. They have a sophisticated method to try to determine what the trend is, and they're just following the trends, whether it's short term or long or midterm, or often it's just the trends for a few minutes. They're just picking up a trend and following it. That's really what's a lot of it. It's not really as complex as you may think. Now, it's the opposite of value investing, because value investing says that you should never buy a stock just because it's gone up, or you should never sell it just because it's gone down, because you know the real value for it, and you should only sell it when you're getting a good price. So, and momentum says it's trending up, so just buy it on that basis. So now, if you're momentum investors, they tend to trade more, and they tend to get bigger declines. When you look at it, they often get caught in the wrong way, and they may have pretty big declines sometimes. And it's also hard to identify these trend reversals. You'll see a trend, it'll work for a while, you get on, and everything's going good. All of a sudden, it reverses, and it's often it's hard to see when these are happening until you're quite a ways into it. So now, the thinking behind why momentum works is that it's probably mostly because of behavioral reasons, because people buy into it, and then people see it, and people start buying in, and then it goes a little bit too far, and that's why it reverses. And often maybe there isn't a rational reason for it. It's just predictably irrational people that get on a gravy train and then jump off of it. That may be really all that's behind momentum investing. But if you study all these major factors and just use them in the conventional way without further insight, but just in the simplest way, momentum investing has been the most successful of all these 11 factor types investing. So now, another one is dividend investing. So dividend investing, you're buying companies that pay reliable, steady dividends. And basically what you're getting then is large, stable, mature companies. You're generally not getting, companies going bankrupt, but you're also not getting, the big high-flying tech stocks. A lot of fast-growing companies are reinvesting their profits into the company, so you don't get those. And, you don't get, the Amazon and those things. And you also don't get, for example, Warren Buffett's Berkshire Hathaway. He's never paid out a dividend. So you miss out on some great stocks this way, but you tend to get the larger, more stable, and you tend to get a bit more steady return than the index overall. Okay, so dividend investing tends to reduce the volatility, and also part of the return that you're getting is the dividend. Instead of having a company that makes 8% a year over time, you're getting a company that grows by 5% a year and pays you 3% a year. And it's, a bit of it is a bit more steady. So now there's literally thousands of sites out there for dividend investing. So, for the amateur investor, the two most common investment methods are index investing and dividend investing. So those are the two that you see a lot. Now, one of the common ways of looking at dividend investing is called the dogs of the Dow. And basically, the Dow is an index with just the biggest 30 most liquid companies in the US. And the idea is, out of the 30, you're only going to take every year, January 1st, you're going to take the 10 Dow stocks that have the highest dividend payout rate. Now, often what you're doing then is you're buying the ones that are down. So maybe they're paying out a similar amount to last year, but the price is lower, so it's a higher payout rate. So there's a big overlap between um, dividend investing this way and value investing. And there actually is a lot of, when you look at these different factors, there's a lot of overlap with certain ones. So now dividend investing actually outperformed for about 50 years, but now it's lagged the last 15 years, which is kind of similar to value investing. So, people start, it's, how in value investing, we're thinking, is it dead? Well, dividend investing is hasn't done quite as bad, but it's generally lagged the last 15 years after doing well for 50. So now the question is, where are we going from here? Do we understand why, and is that going to change? So now there's also, I just want to make sure I didn't miss one, there's various profitability models. So the standard is you just look at, the net income of companies when you're trying to figure out how much they might be worth. But there are some that don't look at the net income. They look at the operating profit, like the general year-to-year operations profits of the company. They don't look at unusual factors and accruals and all this kind of stuff. So it's not the net income. And so what you may see widely quoted if you watch any business news is this thing called EBITDA. Now, as an accountant, I know what this is, but for most people think, what the hell is that? It sounds like they're just trying to hedge. They're not trying to show the real profit. But really, what it is, it's the earnings before interest, taxes, depreciation, and amortization. So it's before taxes, before interest, and it's before all these accounting accruals. So it's just kind of just think of it as the operating income. And that might fluctuate for more logical reasons, and the thinking is it's more effective for valuing companies. Now, there's various models for working out what a company would be worth. The most well-known one was this, called by two guys, Fama and French. They had this 3-factor model. And then also this guy, Richard Sloan, had a quality of earnings. It was kind of his method of doing it, excluding all the accounting accruals. So this is various methods. Again, it's a form of value investing, basically, but they're looking at profitability in a different way. So now another one that's been popular the last, about 10 years ago, the last 10 years, and it's still somewhat popular now, is low volatility investing. So again, you're specifically buying stocks that fluctuate less. Okay, so they tend to be less risky, steady kind of stocks, and a lot of times they're in infrastructure, more slow, steady kind of industries. So they're not the popular high flying stocks; they're just the more steady ones. So now, what the interesting thing about it is, because these tend to be so steady, they tend to not make the news, and people they never get really caught up into the trends, and they tend to be cheaper over time. And so if your stock, let's say that stock is just kind of undervalued a bit all the time, you think, well, you're just buying, it's never going, it's always undervalued. But that actually is a way of consistently, not consistently, it's a way of outperforming over time. And I'll give you an example. So out of all the different industries, if you look at the last 100 years, what industry had the highest rate of return? And believe it or not, it's cigarette companies. Now you think, why would that be? Because as you know, there's lots of people against cigarette companies. There's been less and less of it being bought. However, so what happens is cigarette companies have always been out of favor. A lot of people don't want to buy them, and therefore the shares are always underpriced. And when you get dividends, if you reinvest them all, you're always buying in at low prices. And believe it or not, that's what tends to give you a higher rate of return over time. So that's kind of what's behind low value volatility investing. Another way to do it is kind of buy out of favor stocks. It's the sin stocks or something like that. So actual returns of this have been quite a bit steadier than market, but they are lower than the market. And now, similar to value investing, this method did okay for a number of years. It's only been really popular since, I don't know, maybe 10 years or a little bit more ago. And it did kind of well for a while, but the last number of years, again, it's been kind of lagging, similar to value investing. So another one's called smart beta. And you've probably seen ETFs, and you've probably seen different funds that quote some of these methods. So pretty much I'm trying to understand what they do. So what this is, so most indexes are based on just the largest, most liquid companies, and based on the total value of all the shares that they have outstanding. But smart beta is looking at more. They're weighting it based. It's a type of index investing, but instead of having the largest, most liquid ones, they're using some fundamental factors like earnings or dividends, and they look at companies on that basis and pick companies based on that. So it's not the typical beta big companies. It's we're doing an index based on earnings or based on dividends or based on some formula or something. That's what smart beta investing is. So now it was trendy for a few years, but so again, when you're trying to buy, it's kind of like it's an overlap again between smart beta investing and value investing, because you're trying to buy not the high flyers, but the ones that show good earnings and dividends. So again, it's a method that did well for a while, and then it's now been out of favor. So I thought we saw about like 2012 to 15 or something. There was a number of years where smart beta and was the last one, and low volatility investing were talked about quite a lot, and now it seems to be they're talked about a lot less, because they've been lagging for a number of years. So now then there's liquidity investing. So this is liquidity is basically how easy it is to sell a stock, and the most common way of measuring it is just looking at what's the total value of the stocks that's traded every day. So if you see if lots of shares are traded every day, that's pretty easy to sell yours among that. So investors can easily trade liquid stocks, and it's often really useful in a market crash. Even a lot of professional investors need to keep a certain amount of liquid stocks around, because let's say the market drops and a whole bunch of people start selling their fund. They have to be able to sell something to send the money to the people that are cashing in. So you need some liquid stocks that you can do that. So now, because of this, there's always more demand for the liquid stocks. So stocks that are harder to sell have generally outperformed ones that are more liquid. So again, it's now the ones that are illiquid, not liquid, they have lower trading volume. They tend to be out of favor. They're often value stocks. They might be private equities, but they're not the big, huge companies. They're the smaller illiquid ones. So they could be value stocks, but they could be something else. It's just something that's out of favor, or that on purpose they limit who can buy it. So illiquid investments is a method that has outperformed. Problem is, it's a little bit hard to get good companies. Like, you're buying private equities, how do you do the research on it? And if you're just picking based on lower volume, you need to know, like, you may need to be able to sell it. You may have trouble selling a bit at some point, but it is a strategy that has outperformed over time. So then this is a little bit of an odd name for one: low capital investment and share issuance. It's kind of interesting. So the thinking behind it is there's a term called capital pigs. So these are companies that constantly issue new shares and then spend them to try to grow. So they keep buying other companies or do capital investments, and they keep issuing new shares. Now, companies that do this, they tend to be, the managers tend to be inefficient with how they use their money. I know Warren Buffett tends to value companies a lot by assessing the managers and how effective they are at using the money that's in the company. And his thinking always is companies that are good at allocating capital should not pay a dividend, and they should reinvest and grow their companies. And ones that are not that good at it should pay out dividends, because then let the investor handle their money if the manager is not going to do it that effectively. So now the finding here is that this strategy, then what you end up doing is companies that buy back shares tend to outperform. So now companies that sort of regularly are buying back their outstanding shares, that is it's actually a more tax efficient way of paying a dividend. So you're giving money actually to shareholders by buying shares on the market. You're giving money out to shareholders, and then there's fewer shares outstanding, so the price per share tends to go up. So, however, for most people that still have it, they just see the price per share go up, but they didn't sell, so they didn't pay any tax on it. So it's a tax efficient way of giving them money. So So this strategy is you're looking for companies that don't issue a lot of shares, but that are buying back shares and that are not doing a lot of capital investment. So they're not doing a lot of research, not research, but buying new investments or buying other companies or something like that. So and unless you think they're really effective at it, but most of the time you're actually buying the ones who are not doing that. Interesting strategy. Another one that's really popped up a lot in the last 10 years or so is called ESG investing. And in fact, there's all kinds of stats related to this now. Now, ESG stands for environmental, social, and governance. Okay, so what's happened is these stocks have been marketed a lot, and a lot of people find value in knowing where their money goes. And so these stocks have kind of been bid up. So this is a thing that's it's been quite trendy. It's been popular in the last little while. So, but because they've been bid up for non-financial reasons, we should expect that the returns going forward are going to be lower. And some of them have actually been bid up quite a bit. And there's all kinds of, in the investment industry, all kinds of stats about these. And I think a lot of people are looking at them maybe and using as a marketing method. So the prices get bid up, but you should expect if you buy these, most likely you're going to have a noticeably lower rate of return than you would with other investments over time because you're buying them at a bit higher price. So now lately there have been some negative issues with it because we're in such a polarized environment these days. There's a big issue about who actually qualifies, which companies qualifies, who's environmental and who's not, and who provides good government and who's not, what's social. So sometimes it's thought to be a political thing as opposed to being something that's really of value. So, just a weird example is, Elon Musk Tesla. So it's basically what started the whole electrical vehicle movement. And yet his company is not considered to be an ESG company for some reason. It's because of I guess written policies. It's about the governance area. So, and then and they're thinking that might be political. So on the other side is you got ExxonMobil, the biggest oil and gas company. They are considered to be ESG. So even though they do lots of oil and gas, but it's because they're doing a lot of research on it. But the thing is, so why would the leader in low carbon not be ESG and the leader in carbon be ESG? So there very definitely is a gray area. I know there a lot of research years ago about ethical investing, and it's not a black and white thing. It's a lot of gray areas, and ESG investing is the same thing. So now another method is called technical analysis. So the two methods of analyzing stocks. One is fundamental, is all value investing, is studying profits and all that about how well a company's run. Now, technical analysis, basically you're just looking at charts, and this is what you often see on TV. And I'm going to show you a stock chart, and the idea with technical analysis is by looking at the stock chart, you can see which way things are going. Now, this goes back to the trend following, right? It's mostly based on trend following. But there are some signals that they claim will tell you when the trend is reversing. So, for example, they've tracked the most common one. It's called the 200-day moving average. So you have today's price, and you've got the average of the last 200 days, and you see them on a graph over time, and that tells you if you're above the trend or below the trend for the stock. Then they have various things they call them candlesticks and head and shoulders formations and various formations that they say tell you when the trend is reversing. Now, lots of people believe in this and show them a lot, and it's cool for investors for companies to show this because it's easy for non-sophisticated investors to see a chart and just see, it tends to look good. So, however, there's again a lot of people who think it's kind of crazy and say, every time any of these formations, it just as often works the right way as the wrong way. So this is an overlap with momentum. A lot of people think it's just like astrology. It's just, it's all a whole bunch of hokum. So interesting thing is Jeremy Siegel did a study where he took 8 charts 4 of them were actual stock trends over a period of time, and 4 of them is he just got a computer to randomly generate numbers and print it out on the chart. So 4 of these are real stocks and 4 are not real stocks, and it's got some technical analysis to say, okay, which ones are real stocks? And the truth is, basically nobody could pick them out. Even the professionals and the technical analyst experts couldn't pick them out. I know when I looked at them myself, 2 of the 4 actual stocks I could pick out, and the other 2 I could not. So it's it's not it's not obvious that this is something that works. So now, generally, if when I look at professional investors that do technical analysis as their main process, in general, I find they have a bit lower returns than the market overall. Now, there are some major investment companies that actually will not look at the technical analysis at all. So, in fact, if the analyst writes a 100-page report about a company and has a page about technical analysis, he might get fired for that. They don't look. Some major companies don't look at it all. They think it is just crazy. So, but there are some that use it as their main method, and there's some that use it as a sideline. Like what some companies do is they use their main method, fundamental analysis, and meeting companies and deciding what companies to buy, and they look at the chart only to try to figure out the timing. Should I buy today or next week? Or so it's only for short term. It's only that for the actual trading. So that might make some sense. Now, personally, I've always been a big skeptic of technical analysis. So, however, I look at our portfolio managers and what they do. So our portfolio managers, actually, a couple of them are actually have been presidents of the Technical Analysis Association, and I've seen them actually do a little bit of it, and it's generally worked. And where they've used it is when clients make us, put a significant amount of cash in. The question is, should you invest it all today, or should you spread it out a bit, or should you wait for a good time? And what they often do is when they see the markets are trending down, they'll wait a little bit and they'll buy in a week or a few weeks later. And about 80% of the time, they've been buying in at lower prices than it was on the day the money came in. So it's actually been kind of working for them. So I've kind of become convinced that some people can do this relatively effectively over shorter periods of time. Over the long term, I'm still a big skeptic, but it is a very commonly used method. Generally, long term, for people who use it as the main method, it's a bit lower return. Another interesting one is seasonal investing. So, and this is basically looking at specific times of the year or month or day, and when does the market tend to do well? Are there patterns to it? So now there was a really huge one that was working for decades. It's called the January effect. And I mentioned it before with small cap stocks. And, we found, small cap stocks outperformed over 95 years. But if you blocked off January, they lagged the other 11 months. So January with this huge effect. Now, again, this stopped working 20 years ago. And I think the reason it stopped working is because everyone was talking about it. So then people in December know, oh, you know what? Small cap stocks are going to go up next month. So people are buying small cap stocks in December already and anticipating it. So that's kind of why once something is really well known, it tends to not work anymore. So it's one of the problems with having a systematic method like that is you kind of have to keep it a bit to yourself. Once everybody knows it, most things stop working. So now September has historically been the worst month, and it's the only month. If you take it all the Septembers over time, you actually have a negative return over time. So now, interestingly, is the last 20 years, it turns out the worst month has become August. And again, this might be people anticipating, oh, September's might be bad. So let's get out ahead of time in August. It may have something to do with, oh, winter's coming, or people having to pay for their holidays, or, or something. It's not entirely obvious why this is. So, but there are seasonal investments that kind of, know these kind of periods. And also certain indexes like oil will have a certain period of time when it tends to well, and gold. And so by knowing what to buy at time, there are patterns which often seem to happen similarly each year. So now seasonal funds don't go this granular, but just to throw a few more things. So if you go monthly and daily, So within a month, the first half of a month generally has quite a bit higher returns than the second half, and the best days are generally the first and the 16th of the month. So it might be a lot of people just semi-monthly purchasing their investments. That could be that. But so the first and 16th are good days to invest. Days of the week, Monday used to be the worst, but now it's gotten to be the second best. And Tuesday of all days tends to be the best day to invest, I guess. I think it used to be that people, were happy on Friday and used to invest. Money went in on Fridays. And now it happens a lot of people, professionals don't want to be invested over the weekend because things might happen. So they may sell on Fridays and then buy back in earlier in the week. So again, these are things that are happened these things have actually kind of changed. Now, so the seasonal investing tends to use more of the yearly patterns, or the month by month patterns. So it's actually hard to use anything more detailed. And when you do this, you're doing more trading in and out. And it doesn't nearly always work. So it's not, it's not a foolproof method. When I've seen the seasonal funds done by people that know how to do them, you actually get a surprisingly steady return, but it's a fair amount lower than what you get with the overall market. So a lot of the focus of seasonal investing is not about getting the biggest return. It's about reducing your volatility again. So it's another method of reducing volatility. So, but it tends to be, fair amount lower returns than you get with the broad market over time. So those are all kind of the general ones where you can do computer models for it. Then the other part is just investing with all stars. Now that's a little harder to measure with computers. Big question is who's actually an all-star. Now I can tell you this is how I invest and how our clients invest too. So we work with a couple portfolio managers. So we're the financial planners. We do financial planning for our clients, but we want them to be able to outperform over time. So we try to find, we're not the investors, but we try to find who the top investors are. I've done tons of research over the years and have lots of experience. I've read tons of books and I've developed a good understanding of what the market is, which has allowed us to identify these really elite portfolio managers. And one of our portfolio managers is using an all-star method. So he's trying to find these all-stars. Okay, so in every field has all stars, and you often see there's a massive difference between like the average people and the all stars. You think of the bulk of us, and then there's a small number of billionaires. The billionaires, almost all of them made it all themselves. They didn't inherit it. They just had an idea. They built a company and they made the billions themselves. So it's not like we could have done that, but of course, how do you know how to do that? So I see it. I watch NHL a lot, the hockey, and there's a big difference between there's millions of hockey players and only a very small number actually get to the NHL, and then the average NHL player versus the all stars. We all kind of know who are the 50 best hockey players in the NHL, and those, they tend to get most of the goals and do and get most of the returns. You see, there's a big difference between the average and the all-stars, and that's true in every field. I actually just watched a show by Fareed Zakaria on CNN called, what was it called? I forget the name of it also, but they were interviewing Billy Joel, and it's again an exceptional genius in the music industry, and so it's every industry has this. So in investing, if you can find these really amazing all-stars and have them invest for us, that's kind of our process. Now it's not easy to invest them, but or to find them, but we kind of learned how to do that over time. So now I'll give you an example. So Warren Buffett's Berkshire Hathaway company. So he's a value style. Although it's different value style the last few decades than it was earlier. But basically, so his return, a 40-year return, was 17.9% a year versus the S&P 500 9.9. So he beat the index by 8% a year. Like, that's absolutely huge. So, and so he wrote an article back in 1984 called The Super Investors of Graham and Doddsville. And basically, this was Warren Buffett and 8 of his value investing buddies. And it's kind of just people that he met that all kind of had similar styles. And all of them were beating the market by huge amounts. And so this is way better than the popular. So value investing that you typically see if you buy a value fund, a value mutual fund or ETF, they're mostly just a formula based on low book value or versus market value or something. It's a very simplified method, but these all-stars have way more experience and knowledge, and they've all done way better than that. So I actually have a link to this. It's on my blog. If you go to my blog and just do a search for super investors, you'll find this. I've got this actual article written by Warren Buffett with all of his buddies, and you can see how it's actually, he's got the actual rate of return of his return and his 8 of his buddies, and you see how well they did compared to the indexes over time, and it's just way higher. So now another example is Peter Lynch. So he managed the Fidelity Magellan Fund from 1977 to 1990, and his return over that time was 29% per year versus 13% per year for the S&P 500 in that period of time. So 16% per year better. Now, based on, if you just tried to think what's the chance, is this possible, this luck, the odds of that are 1 in 500,000 that this is luck. So you look at that, there's really no chance it's luck. He's obviously did something really unique. Now Warren Buffett was an outstanding value investor. Peter Lynch was an outstanding growth investor. So we're trying to find people of this level. Now, one of the reasons it's a bit hard to find these guys is everybody outperforms some of the time. Every style that you have, nothing works all the time. And I'll give you the most astounding example of this, and it'll make the point. So most all-star investors tend to outperform roughly 2 years out of 3, but not all the time. So the biggest example is a guy named Rick Guerin. So he ran a fund back in the late 60s to early 80s. So he had a 19-year record and was really one of the worst times ever for the stock market. But his rate of return in that period of time was 32.9% a year versus the S&P 500, which did 7.8. So he actually beat the index by 25% per year for 19 years. Like, that's just absolutely amazing how that could happen. Now, out of those 19 years, he only actually beat the index on 13 of them, and 6 of those years he lagged. So a third of the time he was lagging the index, and yet he beat it by 25% a year. So that goes back to, when I was talking about the Spieber report, how they're taking, consistently beating. Well, they would say, oh, Rick Guerin didn't consistently beat the index. However, he beat it by 25% per year for 19 years. So that would be, amazingly good as far as I'm concerned. So how do we find these guys? Now, we've been searching, we've been working on this method for 30 years, how to do it. And there's kind of a couple steps. One is, if you look at all the different fund managers out there, it's actually quite easy to cross off 90% of them. So it's just like if you're trying to pick the all-stars in hockey, it's pretty quick to come down to, let's say 50 that are the best. If you want to make a list of 50 or like a 40, 50, 60, you can get down to that list pretty quickly. And instead of having there's hundreds and hundreds of hockey players in the NHL, but you can get down to a fairly short list quite quickly. Now, the way we do it with all-star fund managers is there's a few things that are just obvious signs, you just cross them off. So first of all, we get rid of the ones that are performance chasing. They're just always looking at what worked last year and jumping on. A lot of funds, they have effective method of doing marketing, and when you see them, when you talk to them or see what they're presenting, you see these are smart marketers, but that's not the same thing as being smart investors. So a big thing is closet indexing, and there's actually a measure I'll talk about in a minute called active share, but you can see how different they are. And so a lot of fund managers actually, their job security is that they don't, they only lose money when the index does. So they try to always be pretty close to the index. Now, the thing is, if your holdings are very similar to the index and you have a cost of running your fund, it's really hard to beat the index if you have like pretty well all the same holdings. Okay, so that's what we look for. If you have pretty well all the same holdings, then then we wouldn't buy it. So it's a big problem in Canada for Canadian equity funds. Closet indexing is a massive thing. And I'll tell you how I look at it. If you take a Canadian equity fund and you look at the top 10 holdings and there's more than 2 banks in it, that's it. I'm already done. Cross it off. Closet indexer. Let's buy something else. Now, we tend to invest outside of Canada, so we're not buying Canadian equity anyway, but big example of it. Another one, no economy followers. When you see an investment presentation by almost all fund managers, it starts out that say, here's what's happening in the economy, and therefore this is how we're investing. Now, I've done presentations before to show, there's actually no correlation between the economy and the market, even short-term or long-term. So countries that have the slowest growing GDP over many decades often still have faster growing stock markets. So there's no correlation at all between them. So if someone is starting out by looking at what's in the economy, part of the problem is everything's in the economy, everybody knows, and that's already built into today's prices. So that may have affected last year's returns, but it's not going to affect next year's return. So yeah, so they're talking about the economy, then I think some of them just do it a little bit because people expect it. But for fun, if they're all talking about the economy, then they're not all stars. So now we tend to avoid chartists. Now, again, this is technical analysis. Now we'll give kind of a bit of a pass to fund managers that are using it just for short-term time, deciding on the trading day. Or we tend not to use them for ones that are using it as their main method. I don't think it's really worked all that well. So then there's the internet data analyzers. There's some amazingly smart people with really complex, you see these really massive programs analyzing data. And there's a lot of talk late now about AI and what's it going to do. And the problem is AI has got to go past the idea of just taking publicly available information and coming up with something, because that's what everybody does now. Like the information that's out there, everyone's analyzing it, and that's what everybody else, that's what the current prices are based on. So you have to think past what's going on. So basically my thing is, no matter how advanced your program is, if all you're using is the main publicly available information out there, you can't outperform with that. So another thing is no home country bias. So that's why we tend to not use any Canadian equity or at all. We tend to use U.S. or mostly global equity, but some U.S. because the U.S. is basically half of the market. So, and we tend to avoid market timers, the ones that are just trying to constantly time the market, but because the focus should be on long-term rate of returns, not on short-term rate of returns. So this is step one, and this is kind of, it's getting down to the shorter list, 50 hockey players instead of 5,000. But the hardest part actually with all-star, because a lot of people think, how can you ever identify any all-stars? And I can tell you that, like, getting down to a list of 30, 40, 50 all-stars is actually not that hard. We can get down to that list fairly quickly. The question is, we're not going to invest in 30 of them. We're going to invest in 3, 4, 5 of them. A question: who's number one? Who's number two? Who's number three? I give the same thing if you're looking at NHL players. You can quickly look at, okay, here's the top 50 players, but now who's number one? Who do you actually think is number one, and who is number two? So and that's way harder, and it's a lot of it data analyzing, but some things you just have to kind of study how they work and see what skill they have, and you have to look at all kinds of other factors to try to really figure out who those four are. So that takes more experience, and it's more subjective, but that's actually the hard part of it, which is step two in identifying all-stars. So now we've shortened our list from 5,000 fund managers down to 30. So let's try to figure out, so who are number 1, 2, 3, and 4? How do you do that? So now, first of course, they need to have a long-term track record beating the index after fees. And this is usually we're looking for 10 to 30 years. One of the problems with this is that the investment industry only tracks funds by a fund name, but we're trying to track a fund manager. So it's now fortunately, most of the all-stars have been with their current funds for quite a few years. But if a fund manager changes funds, I want to know the track record of the fund. So he was, 5 years with this company, and then 5 years with this one, and then 10 years with this one. So that's the 10-year. And I don't want to know what the track record is, of the funds. I want to know what his personal track record is. All right. So the same thing is, if you look at a fund, this fund's done really well, but the current manager is only done for 2 of the last 2 years. Well, that's not good, because before it was a different guy running it. So you can't count all that. And the investment industry they actually really try to block you from tracking the fund managers and what they've actually done. So that's part of the work that we do, is try to analyze them if they've changed funds. So one of the things that's a really good measure, a very important measure, it's called active share. And it was Yale researchers that studied this. So, and basically active share is a measure of how different the holdings are than the index. So both which holdings and the weighting that they have of them. So, for example, a 100% active share means you've got nothing that the index has. Zero active share means you are an index fund. You're exactly the same. So generally, closet indexes are the ones that are 0 to 20. So there's not much different than the index. So what they showed in the study, the high ones with a high active share, so 80% to 100% different from the index, then the average fund beat the index. Okay. So, and also part of this is, I think that the ones that are way different are the ones that are more confident. Like it's a bit of a job risk for a fund manager to pick a really different holdings than what the index has, because he could be wrong and lose money when no one else is losing. He could get fired on it. So these tend to be the same people that are trying hard to beat the index. Remember when I said, only probably 20% or something of fund managers are actually trying to beat the index? So these high active share ones, first of all, they are the ones trying to beat it. Secondly, is you have to be different from the index to beat it. So, index people will say, well, we have the index. How can you beat it? Because we got the same stocks. And here's an example. Okay, the index is 1,600 stocks. This guy is 20, and only 15 of them are even in the index. Well, there's no logic that says he can't, his can't beat it. So active share is a really big factor, and most of the funds that we're actually in, that our portfolio managers found, have an active share of 95 or 98. It's vastly different from the index. They also tend to have, the fund managers would look for a lot of wisdom insights. So most of them tend to be in their 50s and 60s. It's not that many that would be younger than that. And some people just study a lot and work hard, and you have to kind of meet the person and assess that they are this kind of person. So we expect the fund manager to stay disciplined, don't avoid fads, and also don't change your method when something goes out of favor. And they're looking for stock pickers, not industry pickers. So, and it's called bottom up, not top down. So what they do is they try to find companies that they think are really good investments, and whatever allocation they have by sector or by country determines that's where they found companies. So top down would be, you'd start by saying, what countries or what sectors do I want to be in, and then what's the best company in those? And that style generally has noticeably lower returns than the bottom up, where you're just finding a few really good companies, and that determines what your allocation is. So so we avoid index timers. Index timers are like the industry pickers, and that's really, so this is why there's a lot of ETF portfolio strategies where they're buying a bunch of ETFs, and each ETF is a different sector or a different region, and they're moving between them. And those strategies tend to lag. And again, this is an industry picker, not a stock picker that you're doing. So it's the top fund manager picking stocks, and that's why they tend to beat these kind of the industry pickers or the ETF portfolios. And they also tend to have really focused portfolios, usually 20 to 30 stocks. There are some exceptions to this, but most of them have very few companies, and which means they've done a lot of research on them, and they know these companies really well. So the index might be 1,600 companies, but they've only got 20 or 30. that they know well and that they're confident should outperform over time. Now, a few other important factors that we look for, and you tend to find with the real all-stars. One is they have their own money in their fund and a significant amount. In some cases, some of them have all of their money. This is their fund. All their money, their own money is in it. So that's why they're motivated to, to make sure they get good rate of return in it. So, and it's not like I'm going to buy something for myself, but you guys, I'll buy something else for you guys. They're buying what they actually want to have. So, now, there are all kinds of different ways to beat the index, and talking to these all-stars is really fascinating because every one of them does something different and has a completely different method of beating the index. And sometimes it's things that would surprise you, but basically always they kind of know why they are beating the index. What's the systematic inefficiency in the market that they're doing, or what are they doing that's different than the rest of the industry? So, and they kind of know that method. These tend to be very passionate, hardworking people. Often, sometimes they're a bit abrasive personalities because they really believe strongly in what they do. They tend to have integrity, that they stick with their style. So if a value guy, and he's a value guy, he's going to buy value, and if value's been out of favor for 15 years, but that's what he does, he's just going to keep buying undervalued stocks. And when you invest with him, that's what you're getting. And same with the growth guy. The growth guy is buying these really fast growing companies, and growth gets nailed in a year, but that he's still got a whole bunch of the what he thinks are the best fast growing companies. So you know what you're getting with them. So now they're all focused on long-term returns, not short-term returns. Confident, not overconfident, and so hubris is when you get overconfident with it. And then we look at there's hundreds of stats you can find, so we go through all kinds of stats, just trying to really understand what they are, look at their holdings, try to really understand what the fund manager does. So this is all this involved in try to understand them, and you try to actually meet them. And meeting them is actually really important because you can see what kind of person is this. Is this how do they think? Well, because when you're buying a fund, you're really buying the fund manager, so you want to know what this person is like. And I give you an example. We had a fund that this was a number of years back. One of the top performing funds. The fund manager, like the fund seems to be doing really well. All the stats worked out really well. Everything looked really solid and great rate of return. And we actually met him with my wife there, and we walked out of there, and she said, "There's no way we're investing with this guy." The guy was just hubris. He had this great suit on. He was just the most overconfident, bragging kind of guy. You realize, what, this isn't right. This isn't the kind of guy we want. And he ended up blowing up after that. So you could tell a lot from meeting the fund manager and see what is this a kind of regular Joe that seems to have done well, or is this, one of these passionate all-star, really amazing people that we're trying to find. So now, just to give me an example that this works. So this is our current all-star fund manager. So we have two portfolio managers. One is the index plus method, where he's paid mainly based on how much he beats the index by. The other one, the main one that we're using, where I have my personal money, is he's trying to find these all-stars. So this is the actual graph of his all-stars and the index. Now the blue line at the bottom down here is the index, and these are the four all-stars. So it means fund managers can beat the index. There are a small number that really do well over time. It's not easy to find them, but we know how to be able to do it. So now, again, we are financial planners. We create the financial plan with our clients, and we work with you over the years to make sure you achieve your goal. And most of them need a good rate of return. So I've had a few talks in past where we talked about, like the 60-40 conservative portfolio that you get out of most advisors. You can't, very hard, basically nobody can retire comfortably with that. Most people need 8% rate of return, which is kind of the low end of what the stock market has done long term. And so most of our clients need an 8% rate of return to have the future they want. So that's why we're very focused on investing, to be able to get that kind of rate of return. We try to pay for ourselves entirely by finding these these outperforming portfolio managers. And what we're trying to do is have our clients beat the indexes after all fees, including ours. So if we've done that, like, you could go out and buy an index fund, but you know what? If you invest with us through our portfolio manager, we've been able, up till now, we've actually been outperforming the index after all fees, including ours. So therefore, our financial planning advice is all purely value added. It's not like you're paying a fee for it, you're making less money, but you're getting the advice. Is it worth it? So no, we're trying to actually outperform, plus have this, the highest quality financial planning. Our, what I call full service, is the highest level of financial planning advice that we I believe anybody can have. That's what we've kind of designed, but we're trying to pay for it entirely by having these top fund managers that outperform after fees. So that's why we spend a lot of time looking at investments. And this, this is partly, I'm showing you all the different possibilities and all the things we look at, trying to figure out how do we find the best investments. And this is what our process is. So thanks for listening. So what you've learned today is these 17 investment strategies, what's actually worked. Our stock price is random, our stock market's inefficient. And we went through kind of a history of market thought, look at these 17 strategies and what works and not. And also, how do we identify the real all-star fund managers? So my name is Ed Rempel. My blog is Unconventional Wisdom. It's the #1 blog in Canada for a financial planner. And it's Ed Rempel, www.edrempel.com. If you go under contact, you can request a free 30-minute consultation if you're potentially interested in talking with us. A free 30-minute consultation. We only want to work with clients that are a good fit for us and really ready to be able to work together seriously for their future. So we're trying to find out, are we a good fit to work together? That's really the talk is about, what are you looking for? What do we do? Or are we a good fit to work together? And so also, please like and subscribe both my blog and the YouTube channel. And all that means is we don't market in any way. All that means is I'm trying to do a video, mostly videos or article, every Thursday. And if you subscribe to my blog and YouTube channel, you'll get them sent directly to your email each week. So thanks a lot for listening, and we'll talk to you next week.